people think that, all right, gold's $5,000. And like you just said, well, Gen Z, am I going to buy gold at 5,000? The one thing I can tell you, and I've worked with central banks for over 20, 30 years, is that central banks do not make a decision based on the price of gold.
Yeah.
They make the decision based on their policy. So the policy is either to buy, based on their policy, they're going to buy or sell. And if you take a look, the World Gold Council, for instance, did a survey of central banks. And 75% of the central banks said they're going to continue to buy gold over the next 5 years.
Welcome to Y'all Street.
He's the McKinney debate, the machine that smashes.
100% legit.
So, Chris, you want a cup of coffee?
I just want to be the best.
Thanks, brother.
Thank you, sir.
Bob, you want a cup of coffee?
Definitely. I want a Texas y'all.
I got you this Texas versus all y'all mug since you are on Y'all Street and you just visited our depository down here in Shiner, Texas. What was your initial thoughts?
I have to say I was extremely impressed with Texas Precious Metals. 40 years ago or so, I actually ran Citibank's depository, and it was all manual. And to see it robotic, see the facility, it's just amazing what you can do with technology these days. And it would have made our lives a lot easier, especially the guys that physically moved the bars.
Yeah. He saw a vacuum that picks up the 70-pound, 1,000-ounce silver bars rather than everybody having to just move them physically. So thanks for coming on. Really appreciate it. I just read the book that you had that just came out, Mastering Gold and Silver Markets. I actually got an early copy, which was really nice to be able to read. Me, obviously, I'm somebody who's very interested in this market, but I have a lot of friends who aren't specifically in, gold and silver in any way, shape, or form, but people that I think would be super, super interested. As you mentioned, you worked at Citibank. It kind of the book walks you through basically your whole career from a high level and some of the highlights of it in the first part. And then in the second part, just honestly a masterful ability for education. I think that precious metals markets are important to the world. And so whether you're specifically in them or not, it's good to understand them if you want to have a macro view. And the book was genuinely fantastic. So as a bullion banker, which is what you did for years and years, tell us what a bullion bank is and just like a high level of what you did as a bullion banker.
Sure. Well, I actually started off like Texas Precious Metals Depository. I started in accounting, and I learned physically from the ground up, and obviously the ground up being the lowest floor of Citibank's vault. And I learned everything I could about the physical side of the business. And before I actually went into trading, I was involved in a couple of transactions that I'm sure we'll discuss later. And I kept on raising my hand to become involved in trading and developing into bullion banking. The idea of bullion banking, a lot of misinformation in it. And one of the reasons I actually wrote this book was to explain what bullion banking is all about. And a bullion bank really is in the middle of the, let's say, the tire, and it supports all the spokes. For instance, it provides financing and hedging for mining companies. It finances end users such as jewelry companies or any industrial use that comes into gold and silver. The bank, just like it would in mortgages, it funds these consumers, however, in terms of metal. I've developed relationships with central banks around the world, been involved in transactions from acquisitions to selling to help countries finance their country with still maintaining the positions in the gold and so forth. There's a lot of factors that bullion banks do. Unfortunately, one of the reasons actually I wrote the book was to take out some of the misinformation one of the most popular misinformation in the industry is that bullion banks are short the world's supply of gold and silver.
Why do people think that?
It's simply because some people show what's called the Commitment of Traders Report. And the Commitment of Traders Report shows the positions of swap dealers, producers, managed money. And managed money in a bullish market would be long. Bullion banks, on the other hand, in a bullish market, would be short on the CME futures exchange. However, they're not short outright CME futures. They're long OTC London, OTC forwards, OTC or leasing against it. So they have a matched book as far as an outright position, except for if you just read one single report, which was the Commitment of Traders, they'll say, oh, the banks are massively short. However, they don't take into account their OTC positions that are not reported anywhere publicly.
So OTC meaning the physical supply that they have in silver, they're long there, they're short in New York or the futures, which nets out to zero or roughly zero.
Right. OTC technically means over the counter. So it's not really on the, it's not reported in any available information. But
Totally.
You would go to, for instance, to fund a mining company. Let's say a mine, even today, where gold is $5,000 and you discover a new mine, and let's say the production of the mine cost is, they say, $1,500. Well, that's a great profit, $1,500 to $5,000. But who's not to say that the price of $5,000 won't go back down to a year ago of $2,600?
Yeah.
So you would be prudent in a new mine to hedge a certain smaller percentage so you know you're going to have the float to keep that mine going forever. What the mine would do is ask a bullion bank either to help fund it from day one because they need the money to actually start the mine, or possibly hedge 3 to 5 year out production. If you went and hedged 3 to 5 year production, you would actually ask the bullion bank to sell gold spot today and then move that forward 3 to 5 years for when your initial production comes out. The bullion bank would have to borrow gold to do that. They may go to a central bank, or they may use arbitrage between the CME and the OTC, which we'll discuss later. And they'll take that gold, sell it spot in the market, and then either put that proceeds on deposit for 3 to 5 years, and therefore that spot price today that's $5,000 may be $5,500 5 years from now.
Yeah.
Based on interest rates. So the mining company would be selling gold at $5,500 5 years out versus $2,000, $2,500, of course, lock in a $3,000 profit.
So they're saying I would rather take my $5,500 than deal with the risk of it, dropping down, me not making as much money. And for that trade-off, I'm giving up my upside opportunity if it went up to 6,000 or 7,000 or something like that.
Right, but they would only do that for a very small portion.
Okay.
Because
just to lock in profits
Right.
for operational costs.
if we go way back when gold was $300 and it was $300 for many years, what happened was certain companies overhedged, and therefore the stock price no longer became a proxy for the gold price because they were hedged at 300.
Got you.
So many mining companies back in the 90s stopped hedging altogether, and because they wanted the stock, their equity
To go up and down with the price of gold, roughly. Gotcha.
But today, with a price of $5,000 and a cost of $1,500 or $2,000, whatever it is, you're going to want to lock in some profit just as a hedge to be able to go back and just in case we did have a sell-off.
Yeah, just to make sure. The book is filled with stories from your career. A couple of your biggest ones actually were super, super early on. One happened with Japan's Ministry of Finance, a massive trade that you said you have when you were still kind of a novice. Walk me through that. That's an interesting story.
Yeah. First of all, I was still working at the vault, and
At Citibank.
At Citibank,
Okay.
and there was a group called Citicorp International Trading Corp, and a couple of those traders, they were allowed to trade anything from soybeans to foreign exchange, and we did not have a gold trading desk at the time. It turns out that a contact in Japan brought this transaction in, and the Ministry of Finance was going to produce a coin for the Emperor Hirohito's anniversary. Okay. And what they wanted was 223 tons of gold. Which
How much gold is that for people who have no idea of that?
At today's price, it's in many billions.
Many billions.
Many billions.
Wow. Okay.
Yeah. And what they wanted was all the gold to be 4 nines, which is the purest form of gold.
Meaning 99.99%.
And to understand, the gold today, trading in international standard, is 0.995 pure. So to get it to 4 nines, there's not that much 4 nines gold around in the world. And us or the guys at Citicorp Trading really didn't understand that, unfortunately. And they said, yeah, we could do it. And in the end, we got the deal. Then we had to go out and figure out how to convert 223 tons of gold to 4 nines and then ship it over to Japan.
So you guys said we can do it. You agreed to it before you even truly understood how you were going to get that gold into 4 nines.
Exactly, and
Wow.
that's why we won it, because
That's why you won it.
every major firm, I mean, from Goldman Sachs to all the major bullion banks that were in trading, obviously said they couldn't do it, and we as novices said we could do it.
Ignorance is bliss.
Exactly. But in the end, we ended up doing it. There were a lot of interesting stories. For instance, one was that I had a relationship with the Central Bank of Brazil and Casa de Moeda, who was the gold refinery. And in my job in the vault, I was sponsoring the Casa de Moeda onto the CME exchange as good delivery. I mean, they were just developing their refinery. So I went back to the central bank. I said, hey, guys, do you really want to get your gold known into the international market? We as Citibank will take your produce 4 nines gold for us, and we'll give you 295 back, or we'll pay you for it or whatever. And they became one of the big sources of the 4 nines gold. We also got involved through the Swiss and negotiated a large-scale deal with the Russians.
Okay.
And
Does this mean the Russian government?
the Russian central bank,
Wow.
yes.
Okay.
So we took a significant amount of gold from the Russian central bank. That also helped us. We also went to different refineries. We did swaps and so forth. The story, I think, in the book, as you might know, was that we ended up testing some of the 4 nines gold because we knowing nothing, we didn't trust anything. We had to make sure we delivered what we said we were going to deliver.
Yeah.
And we noticed that we were getting from 5 different refineries the Russian gold. 2 of the refineries, the gold was showing up 0.9967, let's say, instead of 0.9999. And we went back to the Swiss, and the Swiss went back to the Russians, and they said, no, that's not possible, whatever. We said, no, you want to take a look at our tests. Here are the assay tests. What happened was there was a meeting in Switzerland with the Russian central bank and a senior person from Citibank. And unfortunately, one night he was in his room and he got a knock on the door, and it was a lady of, let's say, ill repute wanting to come in. And he said, no, sorry, we're not, you can't come in. He knew what was something shady happening.
Yeah.
The next day they were at a bar. There were different beautiful Russian women, but in the same exact dresses
As the lady before.
as the lady before.
Oh, man.
And so it was clearly obvious that they were trying to get the senior executive of Citibank in a compromised position,
Yeah.
take a picture, and then it'd be over. In the end, we finalized that there was 2 refineries that had actual mechanical problems in their process.
Okay.
And the Russians through the Swiss actually physically took that gold back and replaced it with 4 nines.
Good.
But it was one of the interesting stories. Also, it was a significant amount of money, and the Japanese MOF asked us to move all the gold to Citibank in the U.S., and then once it was there, we should 1 year later ship it into Japan. So we arranged for that to happen. What we didn't know was that from all the flow of gold from the U.S. to Japan changed the balance of payments and also made the yen stronger. And then
It was that big that it made the yen stronger compared to the dollar?
exactly. And therefore their ending purchase price was cheaper because they changed the balance
Because
of
of the foreign
payments.
exchange.
Yeah.
That's crazy.
At the time also, John Reed was chairman, and this transaction was on the balance sheet. And back then, I think it was maybe it was $2.5 billion. Today, obviously, at $300 versus 5,000, you could imagine how many billions it is today.
Yeah, insane.
And we kept on getting a call from the CFO. When are you getting that gold off our balance sheet? So it was a quite interesting transaction.
You were also involved in the very infamous and notorious liquidation of the Hunt brothers position,
The silver position. Yes.
that you talk about in the book. That is, I mean, I think obviously one of the most notorious events in gold and silver markets, and
Especially
I would
in
even
Texas.
say, yeah, especially in Texas, and I would even say in just financial history, it's a major event.
Right. I actually get questioned about that time, not because of I was involved in the transaction, but there's been 2 major rallies in silver in the world. It was the Hunt silver position in 1980, and then the 08 to 11 Reddit financial crisis rally, and why today's rally is different. And we'll get involved in that later. But the reason we got that transaction was because we owned our depository, the Citibank vault. And we basically said that we'll be able to get and make the movements within the vault without, on a confidential basis, because we own the vault and we were taking the metal in our name.
So they wanted it confidentially. And if they worked with a different bullion bank, they'd have to work with a different depository. And there was possible that it wouldn't be confidential between those two parties, or
if they worked with a bank that didn't own a depository.
Oh, okay. Yeah.
So we were buying the metal and then obviously selling it. We weren't keeping it.
Yeah.
But we were able to keep it confidential because, for instance, we took the Hunts bought all the physical silver they could. That being, they took delivery of all the futures on the exchange, took physical delivery. They also took all the delivery of physical around the world that they could, including coin bags. They had, dimes and quarters and dollars that were silver. And matter of fact, I had a person at Bank of Delaware that stored it all, and he basically, I wasn't allowed in the state of Delaware because I became an arch enemy because we were physically moved out the entire holdings of the Hunt brothers out of the Bank of Delaware.
Oh my gosh.
Into Citibank. So we basically moved everything there was. We had to liquidate the futures positions. We had to liquidate everything. So it took us about a year to do. And by the time I was done, I went over to Dallas. They were the Hunt brothers were trading in a company called Placid Oil, which they owned.
Okay.
And all their trading vehicles would go within Placid Oil. And I brought a 10-ounce silver ingot as a thank you to the CFO of Placid Oil.
Okay.
And we're at lunch at, I think, the Petroleum Club in Dallas. I'm sure it still must exist today. And I give him the 10-ounce ingot. And he looks at me, he starts laughing. I said, "Why are you laughing?" He goes, "Well, Bob, I got more silver than Nelson." and that's I sat back. He goes, "You're right. They were forced, unfortunately, to liquidate everything."
Was it margin calls? Were they levered? I mean, what happened?
The problem was they cornered the market, but they also, instead of just paying for everything. They were significantly levered.
Significantly levered.
And the fact is, the banks and dealers, and on the other side of it was also constantly putting up margin.
Yeah.
Because they were short and the hunts were long, and interest rates were sky high at the time in 1980. It was probably like 9% or higher. And therefore, the cost of margin was killing some of the people. However, the CME came in and basically increased margin significantly.
Meaning that if you have, $100,000 worth of silver, you had to have $10,000 of cash behind it. Now you have to have 20 or 30. They increased the amount
Exactly.
they have to have behind it.
And overnight this happened. And there was no way that the hunts were going to be able to make that margin call.
Yeah.
And then I think later on the government came in and made a forced liquidation of the entire position.
So these were two of your first deals when you're in your early 30s?
These were probably the best deals I ever were involved in. I was not a trader at the time. I was in the depository.
Yeah.
I started off in the accounting, the financial control, and then I was running the business unit. But this really were the best transactions I ever involved in my life, and I got hooked. And I kept on raising my hand and said, "Hey, I want to be a trader." And actually, that's how I became a trader. Was the person that ran this unit? He kept on saying he would hire me, and every week I'd go to him and he said, "Yeah, I'm going to hire you." Finally, I got an offer from his competing unit within there, and I went up to him and I said, "Hey, this is it. I have another offer to become a trader, but I want to work with you guys. It's been amazing." And he goes, "Okay, you have a resume?" And I said, "Do I have a resume on me now?" He goes, and he had a napkin. And he goes, "Write a resume." And I wrote it on a napkin, and he took it to the head of the investment bank with the napkin. He comes back and goes, "Okay, you're hired." And that's how I became a trader, actually.
So you went from Citibank's depository to their trading desk.
Yeah, which was another eye-opening, because one thing is being involved with a transaction. The other is becoming a trader and starting a bullion banking business.
Yeah.
And I was like basically thrown to the wolves. I mean, it was impossible to know how to trade when you don't know how to trade. So you either sunk or swim.
So on the Japan Ministry of Finance deal, did that deal end up becoming profitable even after all y'all's noviceness?
Well, let's put it this way. In 86, it made $100 million.
Okay. So that's a lot of money, especially today.
And we didn't get paid for it. Most of it got paid by the contact that was in Japan.
Wow. So you become a trader at Citibank. The book walks through, you become... you go to Republic National Bank, they get bought out by HSBC, and your career just starts to go. You had to kind of rebuild multiple times from you built up Citibank's bullion desk, and then you kind of rebuilt bullion desk a couple of times, specifically at Bear Stearns, correct?
Yeah, in 08, I left HSBC to be hired to run a global business. It was myself.
Okay.
And I hired up Singapore, Hong Kong, London, and New York. And within a year and a half, we were in the top 5 bullion market makers in the world. Unfortunately, the financial crisis came, and I'm sitting at dinner with my family, and my Bloomberg says, JP buys Bear Stearns for $1.
Yeah. Yeah. And then you went over to JP.
Right.
But you had, throughout this career, I don't want to give too much away from the book because I think people should get it. But throughout this career, you kind of become notorious yourself to a certain degree. And you even get pursued to help with the launching of new products like the ever-present and popular GLD, the first gold ETF.
Right.
What was that like? And then what is a gold ETF? Why do people buy a gold ETF? What's the proposition of that?
Sure. I was at HSBC at the time. And basically a gold ETF is, it basically gives individuals much easier access to gold because you're buying a stock. but the stock is backed by actual physical gold. So when it was launched, it was, I think, a tenth an ounce versus 1/10 of an ounce backed each share of stock.
Yeah.
The people at HSBC and the Bullion and Treasury didn't believe in it. And I thought, oh, this is going to be great. And we're going to be the custodian. We're going to make money as the custodian in the vault. And actually HSBC's vault, by the way, was Citibank went out of the precious metals business. And I negotiated, at the time was Republic National Bank, buying Citibank's vault and physically moving it.
Oh, really?
Yeah, moving it over into Republic, which became HSBC. But 20 plus years ago, I got involved with, I was the gold experts per se to get it listed. In fact, I hosted at HSBC's boardroom a meeting with the CFTC, the SEC, and
regulatory bodies,
regulatory agencies, and they didn't believe in the idea of the ETF. And the craziest part, they said, well, it's not transparent. How are you going to price it? And I explained to them it was really simple. You just take, at that time it was a gold fixing. Now it's the ICE auction. And twice a day you would have a gold fixing, an AM and a PM. And we said, it's really simple. You just take the price that it fixes at, and then you divide that by 10, and that's your price. It couldn't be more transparent.
Because of 1/10 an ounce per share.
1/10, exactly. And they kept on pushing back. So I actually remember going to one of the regulators. I said, okay, if you don't think this is transparent, and Enron was happening at that time, I said, take a look at the balance sheet of Enron, and then you tell me what the price of that stock should be. So all of a sudden the conversation stopped and they got it. And that, there couldn't have been anything more transparent in terms of pricing than the ETF. And basically, to this day, I strongly suggest people that want to invest in gold, especially as a trade, the best way to do it is via ETFs. Because ETFs like GLD is highly traded, deep, and the pricing, you couldn't get a thinner price as far as a bid offer spread.
Yeah.
And that it's backed by physical gold. Versus, I do advocate holding physical gold, which is important too. It depends what your goal is.
Why? Yeah.
If for instance, I believe, and you'll see it in my book, there's parts of why from individuals to central banks buy gold. And it's a portfolio hard asset diversifier. Gold, to me, is the ultimate currency, safe haven asset.
Yeah.
And if you want to just have something to be a hedge against your entire portfolio, you buy physical gold and you put it in your vault and you forget about it. And it becomes generational, where you just will it over to the next generation, but you have it in a case of calamity. So that's why you would hold physical gold. Versus if you think, hey, gold's going to go up today and it's going to, I'm bullish for the next 2 or 3 years.
More speculating a little bit in shorter term. Yeah.
So you would buy an ETF because there's physical gold behind it, but there's no premium to get in, and certainly no premium to get out.
There's a lot of talk about Gen Z is now really getting their minds opened up to gold and silver, which, people think is an old man's game. And, I'm here to say that it's not. Gold is $5,000 for a 1 ounce coin. Right. And as you go smaller, you pay higher premiums, per ounce kind of thing as they get down to 1/10 ounce or half ounce.
For physical.
And so, but you say like $5,000 is a lot of money, with the price being what it is. ETFs are a good option for people who, can't go buy 5,000 or 10,000 or 15,000 worth of physical gold. And GLD, I think last I checked, had $170 billion in assets under management. So fairly successful, I think you can say.
Yeah, no. It was, a lot of people at that time didn't believe in it, but it at times trades more than major indexes.
Yeah. So you talk in your book, and you've told me personally that you want to be an advocate for gold and silver. You think that it is good and it is beneficial. Talk about, gold and silver in a financial portfolio. What should people be thinking about? How is gold similar to silver? How is it different than silver? Kind of walk through how you think about those questions and what people should be asking themselves.
Sure. So let's take a look at the last run-up, which was in 2025.
Yeah.
And why, first of all, it was a gold-led rally.
Meaning what?
That the first 6 months, really gold led the way as far as price action. And why did it? I believe that gold is the ultimate currency. And when I am saying the ultimate currency, if you have a currency of any specific country, it's only as good as the credit of that country.
Okay.
Gold is not backed by any country. So therefore it's like a pet rock, and it doesn't have that credit concern. It's also a hard asset. But why has it done so well lately is because it started back in the Ukraine-Russia war, where I like to go back to say that's where the de-dollarization of the world started.
Okay.
And what I mean by that is that many countries started to go away from the dollar, and many countries started buying gold to diversify.
And why did that happen?
Well, especially if we take a look at the last administration, when they came in and they were voted in November 24, and January 25 took place, there has been a lot of flip-flopping first of policies. For instance, tariffs started at, and tariffs were put on Mexico and Canada and taken off, taken off. There's been a lot of threats of tariffs on NATO countries, taken off. In addition to that, you have the geopolitical issues of Venezuela, Iran, the Middle East, and Russia, and so forth. I believe that if you take a look at specifically the European central banks, they got very nervous about the dollar and also the U.S. policies. And if you look at the last maybe 3 months ago, the European Central Bank made an announcement that the holdings of European Central Bank reserves, the number one is the dollar. The number two used to be the euro, is now gold.
Even in the European central banks.
The European Central Bank's number two holding, gold surpasses the euro. The euro is now the number three holding. Why is this? Because countries are diversifying away from the dollar. What's the best way to diversify away from the dollar? But gold. Gold is stated in dollar terms, but it's gold. So we have seen significant amount of buying. I would say 5 years ago, the average buying of central banks maybe were 500 tons or less per year.
Yeah.
And most recently, we're seeing 1,000 tons per year. So the central banks are stepping up their purchase and accumulation, and it's become a much more critical part of their own reserve.
So do you think that that's happening, though, with their buying gold instead of dollars, or are they buying gold instead of fiat currencies overall? Like, for example, the European Central Bank. Are they buying gold in the place of money that they used to buy dollars with, or are they buying gold in the place what they used to buy the euro with, or is it just kind of they're increasing their gold and they're dropping all the other fiat currencies or treasuries, I guess, that they used to use?
Yeah, exactly. They're buying gold to replace fiat currencies.
Okay.
And if you take a look, who was one of the biggest buyers of gold in the European Central Bank? Poland. And take a look at where Poland is geographically. It's right next to Ukraine and Russia.
Mm-hmm.
And just recently, despite how much they bought, the governor of the Central Bank of Poland just increased the allocation for another 150 tons to buy. And this is very important because people think that, all right, gold's $5,000. And like you just said, well, I'm going to, Gen Z, am I going to buy gold at $5,000? The one thing I can tell you, and I've worked with central banks for over 20, 30 years, is that central banks do not make a decision based on the price of gold.
Yeah.
They make the decision based on their policy. So the policy is either to buy, based on their policy, they're going to buy or sell. And if you take a look, the World Gold Council, for instance, did a survey of central banks. and 75% of the central banks said they're going to continue to buy gold over the next 5 years.
So you see this trend continuing.
Yeah, first of all, we have another 3 years of this administration. I don't see that the policies of this administration is going to change. They're constantly flip-flopping, NATO's on, NATO's off, So,
and you're saying the uncertainty of, what are they going to do plays a role in this. I would assume also you would say probably the deglobalization narrative of, we want to make sure our manufacturing is done here. We want to make sure we can make our medicine here. Some of the stuff that COVID kind of showed. Would you say that's another piece of it of countries are becoming not independent, but more independent compared to how they were in, say 2015 or something like that?
Oh, definitely. But I think what the critical part is that as long as we're going to have geopolitical uncertainty and economic uncertainty, this will continue.
Yeah.
One thing I didn't get to answer actually is, we were talking about gold and silver, and we're only talking gold so far.
Mm-hmm.
So gold to me is the ultimate currency. It's held. Actually, one more interesting fact on gold is the World Gold Council came up with whatever gold has been produced in this world from day one to today, 20% of that gold is held in central bank reserves.
Just physically held.
Yes.
Wow.
So when you talk about a deep pocket holder,
mm-hmm.
you're talking about central banks holding 20% of whatever produced. And then there's a scarcity to it. If you take the mine production that comes in every year, only 2% increase per year to the entire supply.
Wow.
So to advocate for gold is really simple. One, you have deep pocket holders. They're gonna continue to buy for the next 5 years, and then you have the scarcity.
Yeah.
And now, why silver? Well, silver also is a safe haven asset, just a safe haven hard asset like gold. However, silver has an industrial demand supply to it.
Yeah.
And in the last 5 years, the silver demand supply has been in a 5-year structural deficit.
In large part because of the industrial uses of it?
Yeah, you have data center, solar,
Yeah.
EVs, there's microchips based on the industrial demand. And I understand that there's been a most recent study saying that this industrial demand may decrease by 1%.
Okay.
That's one study. Another study I saw by Oxford Economics says that the industrial demand is going to increase over the next 4 years. So depending on which study you want to believe, but the bottom line is Metals Focus, who I think mentioned that there's going to be a 1% possible decrease, there'll still be a 60 to 70 million ounce deficit forecasted for 26.
Wow.
So the fact is you have a structural demand supply deficit for silver. So on top of it being a hard safe haven asset, you have that. And then to add to that, you have silver became a critical mineral.
Yeah, it did.
So you have industrial demand, you have safe haven asset, and the critical mineral status still to be determined. There's some congressmen that put $12.5 billion possible stockpiling critical minerals. I haven't yet seen how much of that is going to be silver.
I haven't either. I've looked.
Right.
Yeah.
But you got to think that's going to you're going to have physical offtake from that. And then if you take a look, we spent time on the 25 rally. The first half of the year was gold, and then the second half of the year was silver. That's because we had not just a structural deficit, but physical deficit of being able to get the hands on the silver.
Yeah.
And the reason started because of tariffs. The price, if the U.S. threatened tariffs, let's say 10% broad-based brush tariffs on NATO and Canada and so forth, that meant that what happened was that the price of the U.S. would be 10% higher than the rest of the world.
Because of the tariff coming
Because of the tariffs. So what happened, bullion banks went in and did the arbitrage and basically said, well, I'm going to buy metal in London and I'm going to sell it on the CME futures, which is in the U.S., and that was not a 10% discount yet, but a lot of that was priced in.
So people had priced it in on not even on the fact that they knew that tariffs were going to be put on gold and silver, but just on the expectation that they might be a certain percentage that got priced in.
Exactly, because at $50 silver, that would be $5, and it didn't go to $5.
Yeah.
However, but the chance of it was going.
Yeah.
So, like for instance, one day I remember it was $1.50, and so what happened was the banks bought London Metal, and they then physically shipped it into the CME
In New York.
Yeah, so you're going to buy $1.50 under, ship it in, so you have whatever costs 15 cents to ship it, plus whatever costs to fund it, but you would lock in a huge profit. What happened, and the best way to see this was pre-tariffs, there was 250 million ounces of silver in the warehouse.
In which warehouse?
In the CME
in
warehouses.
New York. Okay.
In the U.S. Subsequent to that, it rose to as high as 533 million.
So it over doubled.
283 million ounces of silver. Yes,
Just
over
because-
double, physically shipped from London and overseas into the U.S. because of this tariff distortion.
All because of arbitrage,
Right.
because of the tariff distortion. Okay.
So now what happens to London? Well, a lot of the London silver disappeared.
Yeah.
At the same time this was happening, there was an insatiable demand for silver in India. So
Okay.
a lot of physical silver at the same time was moving from London into India. So now if you take a look at London, well, they initially had maybe 750 million ounces in their warehouses. And a lot of that was against ETFs. So that metal that was against the ETFs can't be used for trading purposes.
So when it's against ETFs, meaning
It's physically allocated.
physically,
Not-
and they
can't
can't
touch it.
sell it, they
Right.
can't lease it, anything like that.
Exactly. So a colleague of mine in the industry, Dan Golly from TD, did a study on what's called free floating stock. And
Okay.
that was, okay, how much of that available stock could actually be traded versus how much is in there? And in the beginning of 25, I think it was 305 million was free floating stock. Out of
Okay.
the 750, because the rest was allocated to
Healthy liquidity, you
yeah.
would say. Okay.
Then with all the metal that went to the U.S. and all the metal went to India, that free flowing stock went from 350 million to about 100, 120 million. I
Wow.
don't know the exact number. So all of a sudden, there's not much silver around. And the daily trading volume in silver in London was, let's say, 250 to 300 million. Well, now you got 100 million floating, but you had 250.
Yeah.
What's going to happen? The market's going to get squeezed. And as squeezed it did, and everybody now knows September, October of last year was the big silver squeeze.
Yeah.
And what do I mean in silver squeeze? Lease rates went to 30%. Silver forwards went to minus 25% backwardation for like 3 months. And backwardation means that your spot price is 25% higher than your forward price.
Which goes against normal market
Normal
structure,
interest rates, right.
Because
Exactly.
you would say something, I should get an interest rate, just kind of like a bond yield or something like that, right?
Exactly.
I would get a little bit more in the future, but backwardation kind of simply is saying, people are saying, I want my metal now,
Right.
and I value getting it today more
So
than
I'm
I
paying
value
a
getting
25% premium to today versus
which would
the forward.
show a liquidity issue,
Yeah.
a worry that I'm not going to get my metal, all of those kind of things is kind of what the evidence of that shows, correct?
Exactly.
Yeah.
So what happened was, from a fundamental basis, and this when I was building my LinkedIn note, I was saying, please, watch the forward rates, watch the movement, because that's going to matter. And okay, so you have consumers that the banks used to lend to, I mentioned, on a lease basis. Well, they're not lending at 30%. You're not going to pay 30% because you could go out and buy the metal and pay 6% for money.
Yeah.
So what happened was the physical started getting bid up, and the price started getting bid up because of the physical tightness.
Yeah.
It was a fundamental structurally tightness that helped create the.
So the demand is saying if you really want it, you're gonna have to.
You're gonna have to pay for
right?
it.
So let's see how many people will pay for it as it goes up and up and up, and people
Right.
just, I mean, simple economics.
Yeah. So in September and October, we had this major squeeze. And coincidentally, the price from the summer to December or even January just kept on going up.
Yeah. And that's specifically in silver, but gold was as well, just not quite as exponential.
Yeah. What basically, I think in 25, silver was up 150% and gold was up 67%.
Yeah.
or
So
so.
pretty good for your pet rock, you know?
Yeah.
So then starting 2026, it is still kind of going up. It's going astronomical. I remember reading your LinkedIn that you do a lot of commentary on, and you were preaching caution. You were saying, we've had this exponential rise, just, act with caution that, crazy price ups mean crazy prices down. And on January 30th, we got it, and we got it pretty well. What happened leading up to that? Obviously, there was the massive price increase. Did something specifically trigger that day? How did that day happen?
Yeah. So basically, the first thing is the higher price you go, the bigger the corrections are going to be, only because if you're starting at a $30, $29 silver in January 25, and now you're at $70 January 1 of 25, and then going to $100, you're going to have a bigger correction at $100 than you would when it was 29, just on percentage terms.
Yeah.
But a few things led to why we had to have the correction. And then certain things exasperated the sell-off itself. So first of all, specifically silver, because that was the greater sell-off, you had a tremendous amount of implied volatility. The option volatility got to over 100%. So if you think about it, silver's up 150% last year, and in January already up another 50%.
Yeah, it was crazy.
And the applied volatility 100% is going to tell you it's moving. Well, do you think it's going to move up, or do you think it's going to move down?
Yeah.
So that in itself told you we're going to have a correction, and we're going to have a big correction. Then a bunch of things happened. For instance, China. China was a major buyer of gold and silver as well. But then I read stories about people sellers of gold and silver to online and individuals. All of a sudden, when the prices started to tick down a little, they came and they went to they were guaranteeing profits. Sorry.
Yeah, I saw that.
Sorry. Yeah. So they were saying buy gold and silver and we guarantee it. Now, as soon as the price started coming down a little, they started to visit those shops and
try to get their guaranteed profit, right?
Right. Now, those shops weren't anything, impressive. They were kind of what I call bucket shops, and they couldn't get the money out. And therefore, police were called in riots, and people, they just couldn't get their money. So panics in one of the biggest markets in the world for buying and helping that demand go up. Now you're in a panic-driven market. So that's a big issue. In addition to that, in addition to the applied volatility, it became a very crowded trade. You couldn't look anywhere in the news and not hear silver. Matter of fact, I think right before the sell-off, I heard CNBC say, "Hey, this silver, it's a meme stock."
Yeah. Well, SLV's option, just quantity of options that were being traded was insane. It was like number 2. I think at one point I saw that it maybe had even surpassed SPY.
Yeah. Okay. So on the day of the sell-off, $40 billion of SLV traded just as much as SPY. Now,
crazy.
You're talking about SPY, which is a major liquid financial product, versus silver.
Yeah.
Something's wrong there. Options, the number of SLV options traded as much as QQQ. Again, so something's telling you, this is an overcrowded trade. And the bottom line with that part is that, corrections are healthy, but blind faith consensus and leverage create violent sell-offs.
Yeah.
They're just not healthy. And that's what happened. And then things exaggerated the sell-off itself. This is why we had the sell-off. What happened during the sell-off? One, President Trump appointed Walsh as the
like the night
FOMC.
before.
And so everybody said, well, his reputation is a hawk.
Yeah.
So, well, a hawk, I mean, that's high interest rates, not good for the metals, sell.
Yeah.
Then you had, for instance, FOMO, fear of missing out. So many people that missed the gold and silver.
Yeah.
Maybe your Gen Z friends that said, hey, I gotta have some of it. So if you buy silver, it's down $5. Okay. Now it's down 10, I buy a little more. And now it's down $15, I buy a little more. When it gets down to $20, $30, those buyers are weak hands and they were forced to sell out. So you have FOMO, you had people that were looking to lever into it because, hey, I love this trade, I got to make some more. And then you had what I call the leverage trades. You had, I think it was ASQ or something, the double leverage.
The 2X silver.
Yeah, the 2X silver.
Yeah.
Now that was people just get so excited and blind faith. Oh, it's so easy to make money.
Mm-hmm.
So if silver went up $10 today, I made 20.
Yeah.
So you had so many people in these double leverage. And I even heard stories of some investment banks that recreated USLV, which was a triple lever. So if silver was up $30, they're up 90. The problem is when silver's down 30, it's
called.
down 90, and their entire investment was wiped
It's
out.
gone. Yeah.
And then you even have talk about some of these Gen Z traders that were trading Bitcoin, and Bitcoin was flat level. There was some that was trading the Bitcoin levered against buying silver futures, but they cross-margined the silver futures against the Bitcoin. Well, when we had the down day, they had to massively get out of both.
Yeah.
So again, you just have way too much leverage. And when you have way too much leverage and blind consensus, it really creates these violent corrections.
And I would assume pretty much all of this, matters to gold, just not quite as extreme. Correct? Would you say that day?
Yeah, it wasn't as levered.
Yeah.
I mean, the bottom line is throughout this whole thing, I basically said that, corrections are healthy because markets don't go linear straight up.
Yeah.
But, you can't have that blind faith consensus. But the bottom line is that the fundamental reason why we rallied hasn't changed. Do we have geopolitical and economic uncertainty? The answer is yes.
Yeah.
Is silver still in shortage physical supply? Yes. Is it a critical mineral? Is it have structural industrial? Yes. So the thing is now we just need to do the work to get support. If you look technically, it looks like 70 and 85 are different levels. Mm-hmm. So maybe we need to do a lot of work at 70 and then maybe 85. But I don't believe this rally is over. I don't think it's far from over. But I don't believe in price forecasts because you never know what's going to what's going to make it. For instance, COVID, we had a massive rally, but who was going to forecast COVID? Yeah. Who was going to forecast tariffs? Before Trump came in, nobody knew it worked. So I don't believe in price forecasts per se, but I do believe that having precious metals in your portfolio as a hard asset is critical.
Both gold and silver, you would say silver as well.
Yeah, I think gold more than silver, but I think both. I mean, obviously from an investor standpoint, from a retail investor, it's cheaper to buy silver than it is to gold. But the bottom line, I think it's important. There was a study by the World Gold Council that said that if you took all the trillions that were in financial assets and then you took what was invested in gold, it was like 1% to 2% that was invested in gold. With the price increase, I don't know what that percent is, but it's still a low percent. Mm-hmm. And the prudent the prudent investment houses that have come out, not the 20, 40, say 5 to 10% should be in these hard assets. And so I think there's still a tremendous amount of room.
You think people are underallocated?
Yeah.
And so you think, just so I make sure that I heard you correctly, you think that the drawdown was healthy in silver and gold, but you're still fundamentally bullish because of all those reasons. We still have a lot of geopolitical uncertainty. We still have just a lot of doubts. We still have, a lot of debt, all that kind of stuff that shows. And we see central banks buying gold. All those are still fundamental bullish things, you think, more in the long run, even though we just had the correction.
Exactly. And again, if we go back to we mentioned the first run up in silver was in the 80s, and then 2008, 11 was the financial crisis, but it was really, I call it a social media rally. It was, I call it the Reddit rally. Everybody was saying buy an ounce of silver, and then CME raised margins, and there was no fundamental reason why you were buying silver other than it was, a social media craze, and we crashed. Yeah. This rally is totally different. It's a fundamental rally for all the reasons that I give you, and that's why I believe on a long-term basis that I'm friendly to both gold and silver.
And I think you say this in the book as well, but it sounds like your position also for at least most investors is hold it as long-term, not as a speculative trade, unless if people want to speculate, but don't speculate with money that you're not willing to lose, kind of thing. Is that correct?
Yeah, 100%. That's why I advocate physical gold for some people. That's the forever investment. You throw it into your vault and forget about it, and that's your hardcore diversifier. But then if you think that you hear that gold's going to gold, you think gold is, you buy into the economic and geopolitical uncertainties of the world, and you say, I think this gold still has legs. I would much more go into ETFs, and we didn't even discuss equities. Mining equities, obviously, mining equities obviously gyrate more. Mining equities, the downside of mining equities is that you have geographic and management exposure. The management hedge, not hedge, or whatever. But they also tend to have more, they'll appreciate more as well, especially the juniors. But you have to do your due diligence in that.
And looking at each one individually. Well, I seriously appreciated you sending me your book early. It actually was a blast. I think, we were talking over lunch and I was making this point. I think that it really is a market for people who care about macro investing. It's like, I'm not in bonds, but I would still read a book about fixed income because it is just important to the world. It's important to portfolios. And I think bullion is important in that way, and I think that its importance is growing as we see with central bank reserves. So I really do think that it's a great book,
Thank you.
The title is fitting of mastering it. The second half I was fascinated by I think that you have a really good perspective, and it's not a fear-mongering perspective by any means. It is simply, hey, here's the facts and here's objective. Where can people buy the book? Where can people listen or hear your commentary? Where can people find you?
Sure. Right now, I'm just on LinkedIn. It's basically an easy way, a professional way to put your information out. The book, you can get at Barnes & Nobles. You can get on Amazon.com. Just look my name up in the book.
Awesome. Well, thanks for coming on, Bob. I appreciate it.
I know, it was great. I enjoyed it.
Thanks.
Okay.
How do y'all drink this?
That's the Y'all Street.
You gotta stop and buy you the man.